Hey, this is Tom Nash, and the markets are about to go crazy over the next few months. And in this notebook right here, I got all the answers you need. How to make money off of what's coming next, including a few important shoutouts in this little piece of paper, which you have to wait till the end of the video to hear because this is some juicy stuff right there. Now, let's start with the basics and the more important stuff. We just heard that the Producers Price Index went up by 0.1% in June, which is lighter than expected. The expectation was 0.2%. Yesterday, we heard that the CPI, the Consumer Price Index, went up only by 3% versus a 3.1% expected. And that's following a 4% CPI just a month ago. So with CPI being lighter than expected, in fact, the lowest we've seen it since March 2021, with PPI actually being lower than expected. And let me just explain that PPI is a leading factor. The Producers Price Index shows us how much the producers are paying for raw materials for the stuff they sell to us. So if the cost of their materials is coming down, then the prices we will eventually pay for the CPI will also come down. So if the PPI is lighter and the CPI is lighter, that means that the upcoming CPIs will have to be lighter as well. So the S&P 500 has not ignored this, obviously, and now we're seeing that it's almost at 4,500. This is the highest we've seen the S&P 500 since February 2022. That's 18 months high. Not something that anybody expected to see in 2023. And contrary to what Jerome Powell is saying in his speeches over the past couple of weeks about not being done and more interest rate spikes coming, I think the Federal Reserve is pretty much done. Maybe one more, but that's going to be for show. They got to show that they're trying really hard not to screw things up. Because they've screwed up so much of the past 2 years, I get where that fear is coming from. But scientifically speaking, there's no way that the Federal Reserve can justify an interest rate hike in these circumstances. The basic rule for interest rates policy is the John Taylor 1992 rule. We need 2% interest to battle 3% inflation. Right now, the federal rate is 5%, 5.25%. In this case, how would you justify a raise? You're way above the required interest rate. Now, the Federal Reserve will have no choice. They might act out as if they're raising. They might pause for longer than they need to just to show us that they're careful about it. And I get it. Again, they screwed up so much. Transitory. We can make the jokes all day, but they will have no choice because look at what's coming ahead. Ignore the Taylor rule. Look at what's coming ahead. Energy prices, the backbone of CPI, of the Consumer Price Index, are currently at $75 a barrel. That's crude. Now, that's down 18% a year. And we're talking about the peak of prices that crude is going to have this year. Every year, there's cyclicality in the prices of crude oil. It peaks in the summer and it drops in the winter with a little spike in Christmas for travel. And then it stays flat all the way until autumn. So from this summer end, in about a month, all the way until April, crude is only going to go down from 75. So there's no way that this $75 a barrel with a war in Europe goes up in the winter, unless something crazy happens, of course. What about shelter? Shelter went up 8% this year as far as the CPI, the largest component. But shelter is extremely seasonal. It went up 0.6% in the previous month in May, 0.4% this month, because people move in summer. People with kids and family, they move when there's no school. They move in June, July, and August. Nobody moves in September, October, November, or any other month unless they absolutely have no choice. People with kids do not move, not in the summer. And the prices of shelter will have to come down. That 8% is fake because it's cyclical, because it's seasonal. Once this summer is over, prices will drop. So with shelter and energy dropping because of seasonality after the next few weeks, probably a month, how will you justify a raise in the interest rates? Add on top of it what's going on right now with the AI hype. Add on top of it the 4,500 S&P 500, which is an absolute insanity. We're probably looking at a very hot market going forward for the next few months. Now, a few stocks will have to correct before the next bull cycle because they've overran their welcome, so to speak. You can think about Nvidia and Palantir and Tesla. There's others as well, but they will have to correct a little bit before they make their second run. But I think that second run is coming, and I do think that we're seeing a very bullish cycle. So how do I play this? And before I do, a quick shout out to a few important friends of the channel. Lucid, catastrophic delivery numbers, made 2,000 cars in the Q2 and sold 1,400 cars. You can't sell 40% of your cars and you're not even ramped up yet. And Nikola losing coverage, 85% down, $1.50, $1.40 a share. India is backing out of the BRICS, so the BRICS is falling apart. Some really interesting news that nobody could have seen coming. Nobody saw that Lucid, Nikola, and the BRICS is total trash, and now we know. So shout out to all of them. Now, my plan for the upcoming few weeks, few months, and for the upcoming year. Now, I'm going to be dollar cost averaging into the good companies, which I've researched and I've analyzed and I want to be a part of. And I'm going to be dollar cost averaging based on the share price. As long as the share price stays above my threshold amount, I'm going to be dollar cost averaging normally. When and if a correction is coming for Nikola, Tesla, Nvidia, and all these other companies, then if they drop below my threshold line, then I'm going to double down on my dollar cost averaging and I'm going to reduce my basis cost. Very, very simple. This is a system we're teaching on our Patreon, patreon.com/Tom Nash. We teach you a system on how to invest in good companies long-term using a process, a discipline, an objective system. No emotions, no gut feelings. When I got a gut feeling, I go to the toilet. Actual, statistical, objective, scientific way to build non-emotional investing plans for long-term investors. We currently have 5,000 members in our community. We just crossed 5,000 a few days ago. This is such an exciting milestone, and I want to thank all of you who joined. Anybody who joins our Patreon, 30-day money-back guarantees, no questions asked. We just launched Tom's Academy. There's literally one last spot in the Academy. We would love to have you there. There is a Zoom call for the Academy today. So if you join today, you will participate in that. We teach you how to model, how to build your own DCFs, all that good stuff. Thank you so much. I'll see you in the next video.